starting. All attendees are in listen-only mode.
Hello and welcome to the second of our webinars in a series covering each of the 8 levers in Equiteq's Equity Growth Wheel. Today's webinar is on the topic of sales and profit growth. I'm Paula Allerton, Marketing Director at Equiteq, based in our London office, and our presenter today is Shant Uremian, our Buy-Side Director from our New York office. Shant is going to take a look at best practice sales and profit growth, and then we'll hopefully have time for a few questions from you. So if you could please post your questions using the control panel on the right-hand side of the screen, and then we will do that at the end of the session. So over to you, Shant.
Thanks, Paula. Hello, everyone. I'm Shant Uremian. I head up our buyer coverage group, and it's through this lens that I'll be speaking about the topics of today. So today's topic is about sales and profit growth in a consulting firm. If you can only remember one thing, please remember this. In the consulting market, buyers only acquire firms that are growing. A good 2 to 3 years of revenue and profit growth is what most buyers want to see, and even one bad year can reset the clock in terms of optimal time to sell. So your firm's sales and profits are a reflection of a number of factors, including what you're selling, so what are your offerings, how well do they address the demands in your core market, how well you're able to deliver your services to your clients and manage and maintain these clients for sell-on or repeat work while still focusing on the growth of new business, as well as how well you manage the operations of your business and how well your firm is actually able to scale with the increased demands for your services. All of this is a reflection of your sales and profit growth, and it's reflected in a very measurable way. If you're doing well, your firm's finances should be doing well. Investments are made one year that should pay off in increased sales or profits in the other. That's what this lever is all about. How well you're able to manage your business in a way that results in a pattern of growth that you can confidently project going forward. It's important to have a great market offering and talented people with experience to deliver the offering. But if you're not able to translate this into the growth of your revenues and profits, then you're not actually adding equity to your firm either. Stagnant or fluctuating financials don't grow equity and can actually erode equity the longer you remain stagnant. So the implication of all of this is that you need to manage your sales and profits in a way that makes your firm an investable business through the eyes of an external party. As I said, buyers in consulting only buy firms that are growing because there are no underlying hard assets to sweat or to sell off. So your income is all due to your human capital. While you may not be focused on the sale of your business, the question about value is indicated, although not necessarily determined by how much someone is willing to pay for your firm. So again, one thing to remember is that the growth of your revenues and profits adds equity value to your firm, not simply the fact that you have revenue and profits. So taking a step back from the sales and profit lever, I want to put that message into context. The picture here shows our 8 levers of equity value. It's our own proprietary benchmarking tool that's been used in our M&A advisory work for almost 200 firms. The categories, or equity levers as we call it, shown here, reflect the key values on which a buyer will actually evaluate your firm when it comes time to sale. The principles of equity growth and valuation in professional services firms are not always well understood by owners, or for that matter, not well understood by M&A advisors as well. As owners, understanding these levers of equity growth is really the most important route to building sales and profit and equity value. This is the way to unlock significant personal wealth at a liquidity event like the sale of your business. A buyer interested in acquiring your firm will really comb through your operations to establish a level of risk associated with buying you. He'll want to know if he's going to get a good enough return on his or her investment. And our benchmarking tool, which sits behind these 8 categories, asks all the operational questions that we found buyers are interested in and identifies risks that a buyer would find if we were to do the exact same thing. The tool allows us to analyze the answers and produce a prioritized set of actions that you can take to mitigate those risks and enhance the value of your firm. So with that overview of the Equiteq equity growth wheel, let's focus in on the sales and profit growth lever. I'd like to start with a simple message here that we hear from buyers all the time, and that's reflected in an independent buyer survey we commissioned every year. And it's this. Buyers of consulting firms want, first and foremost, their acquisition targets to have financial stability. And we've heard that from buyers firsthand. Why is that important? Well, beyond the obvious, from a buyer's perspective, if a firm cannot profitably grow on its own, why should it be a good investment? So the growth of sales and profits is important. Very simply to show that what you have is in demand, that you can make money from it, and that you can scale your business to meet the growing demand. In this respect, sales and profit growth is actually more important revenue growth is actually more important to buyers than profit. For instance, if it comes to choosing between the continued revenue growth with stagnant profits or stagnant revenue with growing profits, the former will be more acceptable to a buyer. It's also critical to show a consistency between past and future performance. So the shape of your growth curve is important. Jumping up and down causes revenue. Jumping up and down of revenue causes questions by buyers about the real underlying value of your services, and that may deter buyers. The key is to present your financials in a way that reflects the growth of your underlying business, and that ideally shows those fluctuations to be temporary or not part of the fundamental growth curve. So what are the drivers of sales and profit growth in a consulting firm? Well, the equation is pretty simple. We're talking about, in revenue terms, price times volume. Price is about charging market rates for the type and quality of services you offer. In consulting, we talk about day rates or hourly rates charged to a client, and it's very important to get those right. While price may not change, while the price may change with inflation or the type of service you actually deliver, it's actually not likely to be the biggest driver of revenue growth. The right day rate should actually just reflect what the market will pay for your services, and any changes in market rates or your level of value added to your services should be reflected as well. So higher demand services can be charged at a premium, and some lower demand services should also have a lower day rate in order to capture this sufficient amount of volume to make sure that revenues remain high. So your volume of work is obviously the way to increase revenue. This is about increasing the number or size of the engagements, and this is really key to revenue growth. The more you sell, the more revenue you generate, obviously, but selling requires increasing demand, which we will deal with in our sales and marketing process lever. That'll be in another webinar. Now, any discussion on profit has to consider cost management, and that is, in fact, our big focus on profit growth. This is about managing to a best practice cost structure for a consulting firm that allows you to scale and leverage your business as you grow in demand and ultimately in revenue. A critical element of this is utilization and ensuring your employees, which are your main assets, are maximizing the amount of revenue they generate for your firm. Without this focus on utilization, it's like paying maintenance on a car that actually just sits in your garage more than you actually drive it. So with this focus on sales and profit growth, some benchmarks can be highlighted that I'll elaborate on shortly. These involve driving towards a 50% gross margin, 20% EBITDA margin, which is a healthy but I think manageable level of growth, and some factors like managing cash and ensuring predictability of your growth. So let's decompose some best practice financial metrics in consulting to see why those proportions are important. So looking at a breakdown of the revenues as shown here, it's a question about how you spend what you're earning. Of course, we all need to retain a level of profits, and costs involve both costs that deliver work and those that those that are needed to run your business. So delivery costs and overhead costs are the main components. What remains is EBITDA, which is effectively a normalized measure of profit. So how do we come to these proportions? Well, let's take the starting point of what buyers want to see. So most buyers are comfortable with a 20% EBITDA margin when looking at acquisition targets. If the target firm is achieving 20% EBITDA margin, it says that they're doing something right and have a healthy level of profits for a consulting business. So the focus then moves on to other things like how the firm actually delivers its capabilities. If the firm achieves less than 20% EBITDA margin, it causes questions in the mind of the buyer, particularly for smaller consulting firms. The tolerance varies, obviously, with each buyer, but taking a 20% EBITDA margin is a good measure to achieve in order to attract a buyer, and it's a good starting point. So you may ask, why 20%? Well, if you think about the global average multiple for all consulting firms, and that number is about 1 times, or that ratio is about 1 times revenue. So considering a 20% EBITDA margin means a five times EBITDA multiple, which falls within an acceptable valuation range. This leaves about 80%, obviously, for the of revenue up for grabs. Another important metric to achieve is a 50% growth margin. This provides a balance between keeping your staff paid at market rates and having enough left over to pay the costs of running your business. A good rule of thumb is that your offerings should roughly be charged at about 3 times what you pay your staff for the amount of work that they do. Then adjusting this ratio, about 70 to 75% utilization rates. That gets you then down to a 50% gross margin, which is broadly where this number comes from. So 50% gross margin is what a consulting firm should really aim for. So a further breakdown shows these proportions in more detail. To achieve a 50% gross margin, it's necessary to spend an appropriate amount of time and cost on both delivering and project managing your work. So a 70-30 split, or what you see here, which is a 35% and 50% of the overall revenue respectively, works really well. The majority of the costs are spent on delivery and execution, while a good proportion is used to manage and assure that the quality of work being done is acceptable. So with 20% retained EBITDA and 50% allotted to delivery of your work, the remaining 30% is for overheads. We find that an even distribution of overhead costs around generating, managing, and sustaining the business is really the best practice. Generating business refers to things like marketing, sales, and business development. Managing refers to paying the leadership and top management of the firm. So this includes, the managing partners, the CEO or CFO, and the rest of the management team. And sustaining the business refers to the remaining functional needs, including finance, HR, IT, and the like. So aiming for these proportions is not always easy, and some need to be traded off for others during periods of change. However, these benchmarks are really a useful guide and metrics with which to manage your consulting firm. And this really helps in order to ensure ongoing sales and profits are managed in line with a buyer or investor demands. So just recapping on some of the things that we've talked about, it's really important that sales and profit growth is part of your business, and you show a continued growth both historically, and that gives you the ability to project forward in the future. We've said that revenue growth is, if there needs to be a trade-off, more important than profit growth. And the reason for this is because buyers are looking for a growing business, and they feel they can manage profits internally once you're integrated into their firm. The breakdown of EBITDA, gross margin, and overheads, we've provided some metrics around, and that's really around a 20% EBITDA margin, which is acceptable from a buyer's perspective in terms of a healthy level of profits, a 50% gross margin, which allows for delivery costs to deliver the work, and project management and QA. And then a healthy distribution of generating business, managing business, and sustaining the business, in order to make sure that the business can continue to grow as well as deliver the work that's done. So that concludes the main content for this webinar, and we thought we'd leave some time for some questions, so please feel free to ask. Now I'll pass it back to Paula, who can pick up any questions you care to ask through the system.
Thanks very much for that, Shant. That's great. I have had a few questions come in. If anyone would like to post more questions, please do use the panel on your screen, and then Shant will be able to answer them. So firstly, Shant, one of our attendees has asked, could you expand a little bit more on why revenue growth is more important than profit growth?
Yeah, sure. So, so as I said before, the revenue growth is really something that buyers look for in terms of a growing business. So, buyers look for growing businesses as opposed to just profitable, stagnant businesses. And the reason for that is that it shows potential for the business to scale, which buyers feel that they can help scale and that they can find synergies in. So if it's a trade-off between growing profits but stagnant revenue, it's not necessarily a bad thing. But what it does, what it does reflect is potentially a cap or an issue with regard to a number of potential issues, which could be: has the demand slowed down in the market? Is the firm just at its peak and not able to scale on its own? Or are they just not able to manage the balance between delivery and business development? So that's really why the revenue growth is really a more important factor than the profitability when it comes time for a buyer to be interested.
Thank you, Shant. The next question is, with 10% for general business broken down between marketing, sales and business development, would you say there is a maximum that you would cap on marketing as a percentage of revenue? Obviously, as a marketer myself, Shant, I would say go high with that number.
Is there a cap on the marketing spend? I think it's so there's no cap. I wouldn't say that there's a cap. What I would say is that you obviously need to, every firm needs to manage the amount of demand they wish to create in harmony with their ability to deliver work. So oftentimes it comes to getting a big project, which you've worked a long time and a lot of effort to achieve and to win. And then the focus entirely turns to delivering that project or a number of projects. And what happens is, you could scale back on your marketing spend at that time if you feel that you are at capacity and couldn't take on any more. So I don't think that there's a cap. There's certainly a need to balance that spend accordingly. And it's really to calibrate the amount of work that you're able to deliver versus the amount of work that you're able to sort of win and continue to deliver. And ultimately what you want to show is a smooth, steady growth curve. And the reason for that obviously is to be able for a buyer to project that into the future confidently. So the short answer is no, there's no cap and there's no limit, but it really is a balance between how much demand you want to create and how much you can continue to deliver.
Thank you, Shant. Could you tell us, one of our attendees has heard that buyers of service firms will only do so with an earn-out for the seller. Is this true, and can it be avoided?
So earnouts are it's not an absolute rule. Earnouts are very common in consulting deals, and the reason for that is what I mentioned before. Is because the buyer's not really buying any hard assets; they're buying people and they're buying capabilities. But a transaction is a very disruptive event for both parties. And what can happen is that if all of the money is paid up front, there's a risk that the owners or the shareholders who receive that money could leave or could get less motivated to deliver the growth that was promised. So it is a common thing. What we see in practice is a balance between earnouts and upfront payment. And obviously, when it comes to a competitive bid situation with buyers, what buyers will sometimes do is initially offer an earnout, and then in order to make their offer more competitive, they'll change the balance of the upfront payment to the earnout in order to make it a more attractive offer, rather than increase the entire amount. So earnouts are popular, yes. They're not always the case. Buyers, particularly, we find non-consulting buyers, so big corporate buyers that are buying into a consulting firm, tend to be the ones that are more have more of an appetite for upfront payment rather than an earnout. But it's not an absolute rule, but it is common.
Thank you, Shant. Is it more valuable to a buyer to have more clients with smaller revenues per client and per project, or 1 to 2 large clients with a large revenue from those clients that's sustainable and renewable annually?
Yeah, it's a good question. So, so with all things, it depends answer. But certainly client concentration can be seen as a bit of a risk. So if you're earning 70% of your revenues through a handful of clients, or two clients, let's say, then a buyer might see that as a risk, because if you're not able to sustain that same level of revenue, or sell on to those two clients, then it's very sensitive that your revenues could drop off a cliff from one year to the next. So so it is a good idea to, if you have a lot of client concentration, to start to spread that as much as possible, while still showing some key clients that may be attractive to a buyer, and showing that you are able to generate a lot of money from one or two big clients, and be able to sustain that. So the short answer again is it's probably better to be diversified in your clients rather than concentrated, because that can be seen as a risk. And if one client, for whatever reason, turns away or decides not to renew with you and goes with a competitor, then that could destroy much of your revenue. And buyers see that, and so they may adjust for that in the price that they offer.
Thank you there, Shant. Is there a minimum level of revenue at which buyers become interested to acquire?
Yeah, so this is a question we're often asked, and there is a point at which buyers just find certain acquisitions a little bit too small. Now, having said that, the universe of buyers out there is very large. So there is, when we think about acquirers of consulting firms, we often think of the big, most frequent acquirers, like the Big Four, like the Accentures. But the reality is there's a huge middle market of buyers of consulting firms, and their appetite and tolerance for lower revenues is a bit greater. So they will invest in smaller consulting firms. But in general, I think above 5 million is probably where you'd want to be as a minimum in terms of revenue, and that's 5 million, I'd say, US dollars. But that would be, an absolute minimum. From our buyers' research, we know that buyers have said in aggregate and on average that 30 million is roughly the amount of revenue that they like to acquire per acquisition. And the reason for that is because that's both a sort of easily digestible acquisition for most buyers, and also it's probably at the scale where the integration into the buyer is not so cumbersome. So it's a very palatable level of acquisition. So minimum, bare minimum 5 is probably what you'd want to start with. Ideal, we've heard from buyers, is about 30 million in terms of revenue, and what we hear from buyers all the time is the larger the better.
Thank you, Shant. I think we have time for one more question. And for those of you that I haven't been able to post your questions to Shant, we will come back to you directly afterwards. So Shant will respond specifically to you on your question. But the final question is, would it be important to develop new revenue models other than time and material? For instance, services, no cure, no pay.
Yeah, and I think that's, again, a very good question. So what we're increasingly seeing from buyers is that a balance of revenue, the balance of the revenue profiles and the services you offer are becoming increasingly popular. So what was once in a consulting firm just time and materials based services, so you'd get a bunch of very bright people. You sell their expertise, which is through their time and working on a client, and you'd get a high margin for that. Increasingly, buyers are asking for some kind of balance, some kind of, whether it be intellectual property that helps you generate revenue, or some type of service that helps you sustain that revenue, in order for the projections to be a little bit more stable. So there's, again, potentially building a floor of the fundamentals of your business and that curve that we talked about. That's becoming increasingly popular. So, yes, it's a good idea. It's I think in general, I think making it work is a different story. But certainly a balance between high margin consultative or advisory type work that leads into some type of service offering that retains a client and enables you to sell on certainly makes for a very good financial profile, and should help to better project your financials into the future.
Well, that's all we have time for. Thank you very much, Shant. Thank you for listening, and we hope you'll join us again at the same time next week when we'll be looking at the third of our 8 levers, client relationships. Meanwhile, this podcast will be available within 24 hours, and we'll be sending you a link so that you can access it again. There is plenty of interesting and useful material on our website, equiteq.com, and in our thought leadership program, Equiteq Edge, which you can join for free. And finally, if you have any questions or comments, please feel free to contact us. We'd love to hear from you. Thank you for your time, and thank you, Shant.